And today we are talking all things wealth, money, financial freedom, and a term that we're going to share with you that you haven't heard before because I just got to learn about it. You're going to learn about it as well. So today I'm with Keith Blackborg, who is a tax strategist, a wealth optimizer, not just a wealth strategist, optimizer. So we're going to learn more about that. If you're in business, if you're an entrepreneur, you want to stay tuned because why are you in business? Are you there just to work 9 to 5, 9 to 9, 9 to 10? Don't see your family, don't have the time to have your recreational activities? Probably not. Maybe you want your business to serve you. Now, how are you going to do that? Well, you need a money journey, you need a wealth journey, you need to find a way of getting that business to help you to be what we call work optional or financially free, whatever wealth means to you. So with that, I've got Keith with me. Keith, congratulations and welcome to the Business and Wealth Show.
Mac, thank you so much for having me.
You are most welcome. Hey, Keith, generally at the start of these calls, I like to ask people to tell us about their entrepreneurial background. So what's your entrepreneurial journey? What happened? What is it you do? Are you an entrepreneur? Or, I know you work for a hedge fund. So tell me how you came to do what you do now.
Yeah, I started my career at Deloitte as a CPA in San Francisco. Way back when, in time, I transitioned to owning my own CPA firm. My wife, meanwhile, we got started in real estate on the side, so she ended up managing our real estate. So we started with real estate, rentals, flips, wholesaling in 2010. I'd like to think that we were geniuses for timing that. Some of it may have been, we were just lucky. In 2013, we moved over to apartments and hotels. We were then in the Dallas area. And so growing that and then also owning a CPA firm in that allowed us to really grow really quickly because we were personally practicing a lot of the things we were doing. 2016, 2017, I thought Hillary Clinton was going to get elected president and that was going to cause the market to crash. And, real estate only goes in 7-year cycles. I was wrong. But we ended up having a big exit between 2016, 2017, readjusting life, traveled the world for 3 years, had the best souvenir possible. That was our firstborn son in 2019. And then coming back to it, I thought about it. If I know commercial real estate syndication is one of the best ways to make money reliably. However, I wanted to have more of an impact. I really like talking wealth and taxes, and I have something most never get, and that's enough. And so we transitioned I started Financial Journey, and it was really a way for me to walk alongside other people who were in that journey and have some fun along the way. We do some travel and some fun stuff as a group.
Fantastic. It sounds good. I'm sure we're going to get more into it. Now, for anyone listening in, why should business owners or entrepreneurs right now stay on and listen to this particular show? Why should they stay?
I think the biggest thing we're going to talk about is how to become CEO of your wealth. There's a key transition most business owners miss where they're so busy making money that they miss the opportunity to become wealthy.
Awesome. Awesome. On that note, let's talk about one of your premise, which is work optional. And first time I heard it was from you. By the age of 30, you were work optional. I use a different phraseology, but tell everyone what work optional means.
Sure. So first and foremost, I learned telling a bunch of entrepreneurs who are go-getters and like to succeed to retire sounds terrible. They don't want to retire. They want to do things.
That's
And
one.
so work optional is really about that freedom to work on the things you're passionate about if you want to. But if you're burned out and you need to take a season off, whether that's spending time with some friends or family or traveling the world, you've got the finances and means and time of freedom to really go out and explore and do some of those other things.
Yeah. And so some people may use the terminology financial freedom. Some people may use the terminology retirement. I don't like the word retirement. Why? What are you, your old horse? You're going to be retired, and that means you're no good to society. But I do like the words work optional or financial freedom. Having the option to work if you choose to, having the option to
Mhm.
spend more time with your family or friends if you have to. So fantastic. I love that. So tell us about the work you do. as a wealth optimizer and a tax strategist. Tell us about some of this work and why it's important.
Sure. So a few things that come to us. If you go to a normal financial advisor, at least in the States, they're mostly stuck selling you products, stocks, bonds, etc. And in many ways, I'm helping unlock like what does it look to set up your own virtual family office? Where most of our clients aren't wealthy enough to set up a full family office where you need 1 billion or so in capital to do that. And they're not the poor guys who, that sounds terrible, where they're not folks with under $1 million net worth that are primarily focused on stocks and bonds. It's really those that have made some money and they likely own a business or they're an entrepreneur and they own some real estate. And so really it's an educational component about what do we need to be doing from a strategy perspective to really shift into how to optimize your wealth growth over time. And there's some key transitions most business owners miss. And as a result, they never really grow the way they could.
What are some of the things that they miss then? What are some of the key things that they should be considering that maybe no one ever talks about?
So if you have $1,000 net worth and you're able to earn an amazing 20% return on your money, that's $200 in the year. And so in that case, you probably need to work a little harder, grow your net worth, grow your business, put your effort into something to grow that nest egg. But when you have $1 million net worth and you can earn a 20% return, that's $200,000. Or do the math. If that's a $5 or $10 million net worth, at $10 million net worth, you could now be earning $2 million a year if you really knew how to grow it. And so the point is, as you grow and you become more sophisticated, the size and sophistication of your wealth and tax strategy needs to match the size and sophistication of your business. So as you grow, you don't necessarily stop paying attention to your business, but spending just a few weeks a year really concentrating on how to grow that wealth will get you so much further in the long run. If your primary goal, if the reason you're in business is financial, business generates a lot of income. It doesn't generate a lot of wealth. And so there's some other things we need to do to really grow that wealth over time.
So I love that. So their business, our business, is there as a income generator,
Yes.
and the other assets that maybe we'll talk about more, whether it's bonds, real estate, whether it's stocks, whatever it is there as a wealth creator or wealth accumulator.
Correct.
Okay, got it, got it. So in simple terms, what we're saying is work your business, get it cash flowing, making profits or whatever, utilize some of that into other assets that will multiply and grow your wealth much, much quicker. Love that. Now,
Correct.
you reached work optional, which I call financial freedom. You reached work optional by the age of 30. You must be a smart cookie because I reached work optional by the age of 36. I'm 54 now. So that was whatever many years ago. So what was the strategy you used to reach work optional financial freedom by the age of 30?
So I think it was two things. I think it was luck, and I think a lot of business owners underplay with the role of what luck is. Secondly, it was seeing the market and taking advantage of it. So our trajectory, we bought into rental houses, we started flipping, and then we got into commercial real estate. Along the way, I served as director of acquisitions for a hedge fund in Texas, bought 875 houses for them in 9 months, and that was a whole education within itself. And so made some money quickly, and as a result, also had to hire, had to learn how to manage, had to lead as a result. And so we accumulated quickly. In time, as I stepped back and had some exits from those assets, as the CPA who was working with some of the most successful people in the Dallas area, I knew who the best performing syndicators were. I put money with them. They were often people that were doubling their investors' money every 2 or 3 years on these projects where they're flipping apartments. Now, some of that market has changed, and it depends on where you're at. It's not quite the same as it once was in Dallas, but I was still able to grow that over time. And as I made money in commercial real estate, I was able to expand to oil and gas, do some Bitcoin, put some in stocks, other private equity, venture capital kind of things. And so along the way, I really learned how to manage that alternative portfolio of assets that has really been able to grow so much faster than your typical market trends.
Great point. So why is it important to, at some point when you're accumulating wealth, to diversify into other asset classes?
Yeah. So you concentrate where you want to thrive and really grow fast. You diversify to survive, and you're not going to grow as fast, typically, like just putting your money in a stock market,
Mm.
but it's what's going to protect you if your business goes down. For example, one of my clients is the world's largest exporter, or the United States' largest exporter of goods. And so he's got a business that he's actually been selling a piece of. Why? He said he's got more than enough. He could grow that. He could probably add another 10x his business over the next 10 years. He's also saying if one of those container ships catch fire and I lose money, I'm liable for that. I don't want to be responsible for that. He's like, I have enough, Keith. So let me take some money off the table, go diversify. He's like, my kid, me and my kids, 3+ generations, we're going to be fine. So
Mm.
how do we de-risk this? And I'm going to spend some more time with my family and some of the other things that I care about, because he doesn't feel like he needs more.
Right, 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 right. De-risking. So, as part of the work you do, what strategies or what should our listeners be watching out for in terms of if they want to grow their wealth? In other words, high return in investment and low risk. What are some of the factors to consider for high returns? Because there's a lot of people who make
Yeah.
pieces out there. I know you're not selling a particular asset class, but you are giving advice or strategizing. So people say, yeah, go into this high returns, cryptos, and people have experienced that and they've been burnt. They have lost.
Yes.
So what are the things to be considered?
So first and foremost, we look for asymmetrical risk. Where is there a high chance of upside and low downside? And so one example, I'm not giving this professional advice, but one example that we might identify is platinum. When is the last time you've heard anybody talk about platinum? It used to be correlated to the dollar, is trading at a low. Go look it up. Natural gas in the United States is trading at $2-ish right now. And that's lower, especially if you adjust for inflation, than it's ever traded before, even in the 1960s. So the longest it's ever been tracked, it is at that price. So that's an opportunity. It's tough to store natural gas, but maybe in our case, we can do a Bitcoin mining play where I don't know what Bitcoin's going to do up and down, but if I can dollar cost average in it over time at a severe discount through a unique vehicle that's going to give me access to it, that's a way to play on the upside. The other thing is, how do we de-risk deals? Traditionally, most individuals, like you got your doctors and your lawyers and stuff, and they're trying to evaluate these investments. Most of the time, they don't have the experience to do so. And so I don't make money based on how our community invests. I've been intentionally set it up in a way so there's no conflicts of interest. We've got an independent due diligence council that vets all the deals. And so if we're looking at an oil and gas deal,
Hmm.
we've got the chief drill officer of a publicly traded company that's part of the community that's willing to weigh in, along with some other oil and gas engineers. Versus our doctors, we're able to help vet a medical practice buying fund as a result. And so it's when people are coming together and bringing all their individual experiences from their own careers to a deal that is relatable to them. That's how, as a group, we work together to get better deals, de-risk the bad ones, and really invest in the things that have the best chances of an upside.
Great, great, great points well made there. Now, one of the things when people say to me, Mac, as a business and wealth coach, Mac, should I invest in this, real estate, crypto, stocks, whatever it is, whatever new fandangled things people come up with? I say, look, before you invest in any of this, make sure you get the right education.
Mhm.
Get the right education because education is going to do a minimum of two things for you. One is you are going to
Yeah.
minimize your chances of loss. Not that you can mitigate it a little bit by getting the right education, so you know
Yeah.
what game to play.
Yes.
Yeah, and the second thing is often there's going to be creative ways of doing that play
Yes.
without
Yes.
maybe needing a lot of money. So, for example, real estate. Mac, I bought one real estate property. I want to buy more, but if I keep buying more, I'm going to run out of cash. And I said, that's case in point. Get the education, and you can also learn how to acquire real estate, sometimes with little or no money, if you know what to do.
Exactly.
What's your thoughts on that?
Excellent. I think that's a great point. I think education is a huge part of it. The second thing that is often underrated is experience. And what do I mean by that? Most entrepreneurs, that one of the reasons why they're successful in selling is they've got a healthy dose of hope and optimism, which is really good in business.
Yeah.
That same hope and optimism, not so helpful when evaluating investments
Mm.
because you're hoping it's going to go well. And so, to your point, that there are sometimes people get burned, they get burned on one thing, and then they leave that asset class and they're like, oh, that didn't work. Let me go try something else. Let me go try something else. I would say that's the right time for you to stick with something. You now have experience with that. You've learned a way for that to burn you. You're going to be more familiar with that. And now you're going to have a healthy level of cynicism when vetting those deals in the future. And then also getting around other investors, community that also who have been through that education, but can also point out things from their experience. So you learn through them and you don't have to learn those lessons the hard way.
Great point. Great point. Let me tell you a quick story because I think our listeners will relate to this. Many years ago, when I still worked in corporate, now I've been an entrepreneur for over 24 years, but many years ago, I had a pile of money in my bank account. And I remember my bank said, you've got this money sitting there. It's not really returning money for you. Um, we can advise you on what to do with it. Come and see us. So I went to see one of these bank people, and they said, look, we've got this portfolio, this fund, high risk, this one medium risk, this one is low risk. Which one do you want? And I don't know what I'm doing at that in those days. So I invest my money. A year later, the particular fund that I was in was now only worth the statement I've got. It says now the money I had is now half. It's now half. And I'm, oh my goodness, where's my money gone? Where's my money gone? This is my bank that I trust. And they say, well, the funding performed very well, and this is what. So I go and read furthermore, and it says admin and management fees. And what I laugh at it now, but at the time I'm thinking, you're charging me money to lose me money. Oh my goodness. And it wasn't until later on in line of our conversation when I got the education and I got some coaches who said, what they said is, start taking responsibility for your own money rather
Yes.
than relying
Yes.
on other people to manage your money for you. Take responsibility for it. And one of the things you talk about, Keith, is being CEO of your wealth business.
Yes.
Tell us a little bit more about that, because I've been stung and I learned the hard way.
So you're absolutely right that a lot of people don't take responsibility and they blame others. And this is why, as the CEO of your wealth business, or a lot of the clients I help, self-directed millionaires, it's people who most people got wealthy in their business because they were really focused on doing one thing. It doesn't necessarily mean that they know how to manage their wealth. So, as you said, it's about getting some education, getting some help with some strategic planning, which is something we offer, and then getting around like-minded people who have also been doing it. So you're not just listening to one speaker, you're getting the opinions of a bunch of other people. And if you're getting a bunch of people that are also wise and know what they're doing in an area, there's some safety with the multitude of counselors. It really makes a difference. And it allows you to own up and really take charge of your wealth. And with just a little effort, getting some education, this is how you can go from like an 8% market return to most people in our community are earning 12% plus on average in their portfolio.
Amazing. What is it you know now that you wish or hoped you knew when you were 22, 23, 24?
Oh, um, boy, that was a little bit. So really the biggest thing I've learned, if it's not a hell yes, it's a hell no. Meaning, when you're looking at these investments, you're looking at a business deal and something doesn't feel quite right, but you're going to press on with it anyways. Maybe there's a little greed or something in there. But if everything's not aligned, then I'm going to say no. But
Mm,
when everything is aligned and it feels good on all levels, and your spouse and the people or friends are like, yes, this is a deal for sure. Absolutely. I don't have any qualms. There's nothing in your gut. That's when I go all in on something.
wow. Yeah, that makes a lot of sense in terms of due diligence, in terms of actually
Mhm.
calculated risk. That makes a lot of sense. So part of the work you do is providing tax advice, tax strategy. Tell us a little bit
Yeah.
more about that and why is that important for entrepreneurs, business owners?
So most business owners are going to spend 50, 52 weeks a year working in their business. And you're going to spend all that time earning money. And if you could spend a week or two, learn the tax strategies associated with your business and whatever jurisdiction you're in. I know in the United States, I could typically take somebody who's at the 37 to 50% tax bracket once you factor in state taxes, and
Hmm.
we can drop that by 10 or 20%. And
Right.
that's often going to yield 5 or 6 figure results in terms of tax savings. It's easy for me to pay for myself with those kinds of strategies. And the point is, it's not just about how much you earn, it's about how much you keep.
Right. I like that. It's not about how much you earn, but how much you keep. And often some will say that that is evading tax. And why would you do that? Pay your taxes. These large corporations have mechanisms in place where they're providing employment. They're having tax incentives and tax breaks because the government provides it. But most people don't know about these incentives, and hence they pay too much tax.
So the US Supreme Court back in the 1930s ruled and suggested that it is in everybody's best interest and it is perfectly okay to arrange your affairs in such a way to pay less taxes. So you're only required to pay what you need to pay. So by that extension, I know me and a lot of people in our community are really generous. They give generously, and I will still pay every tax that is due. But if I can structure things in such a way that is going to allow me to retain more, that also allows me to up my giving, my charity.
Mm.
And so, who do you think is a better manager of your money, the government or you? They're certainly going to take their piece of it. But if I can give them less and do more good, either by giving it directly or reinvest in my business, they're going to get a piece of it. They take half of it when I die, anyways. So they're going to get their cut. And I think I have a responsibility to those and those I care about to pay just the legal amount I'm required to pay. Also, in the United States, the tax system is enormously complex. As a CPA, there is safety in that complexity, meaning there is so much complexity and there's so many tax strategies out there. Some of it is just identifying from the hundreds or thousands of possibilities out there, what is a good fit for somebody's particular investment strategy or business strategy. And that's where I help with the alignment.
Got it. Got it. Got it. Listen, I'm going to get to the core now. Now, we've got entrepreneurs and business owners listening, some corporate people listening as well. The and the real question is this. Most people are going to be working to the age of whatever, 60, 65, 70,
Yeah.
because that's the system, right? And
Yeah.
that's what they've been told. Work to this age and retire, right?
Yeah.
However, smart people like you and I know that you can reach what we call work optional, work if you choose to, or financial
Yeah.
freedom, having the freedom to choose to work. Now, how can someone take that notion on board and using what you teach become work optional or financially free in the next 3 to 5 years?
So there are three paths to wealth. And I will say the most common path for the clients I work with is they already own a business that's already doing well. And often what we're doing is we're looking at their business and how do we package it up for sale? Not necessarily that they're going to want to sell, but what that does is we look at the financials, we look at the team, the SOPs, and help structure that in a way that's going to optimize the sales price. And optimizing a sales price, getting the highest multiple, that's also going to reduce your time, structure it more like a company, less like a job, and make it sellable. And then at some point along the way, you've been learning how to invest, you have that big exit, and you've learned how to invest with 500,000, $1 million, whatever you've had along the way. And now you get that big exit, 5, 10 million or more. Now you feel more confident about how to invest that. So if I'm looking at ways to build wealth, starting a business has the highest potential of being super rich, but it also has the most amount of risk.
Mm.
Owning real estate is going to take a little longer, maybe 20 years. In the United States, with some time and effort, I might be able to buy one rental house a year for 20 years. 20 rental houses is enough for me to retire along with that. So real estate, commercial real estate, it's a little slower, but it's the most reliable way because I hate to say it, you don't have to be a genius to do real estate. Like you've got to understand, you got to fix it up. It's got to look nice, got to rent it out. And that's kind of it. It's pretty simplistic. There might be some rules and regulations, but it's not that complicated of a business. Lastly, the longest way and the least reliable is stocks and bonds. If you think of who is a millionaire, in their 20s, they probably owned a business. If they're 30s or 40s, they more likely did it through real estate, or that was another factor. Stocks and bonds, they're most people in their 60s or 70s just simply because it takes so long with an 8%-ish rate of return to get there. And so they're going to become wealthy eventually, but they're not going to be able to enjoy it in their youth. And if they get one poorly market time downturn right before they're going to retire and it brings 40% of the wealth down, they can just be unlucky and have their financial freedom wrecked.
Wow. Well put. Very succinctly put. Love that. And in terms of the very great explanation. Now, in a moment, I'm going to come back to you for any last words, anything that I should have asked you, I haven't asked you, and you can really give us some more golden nuggets. You're listening to the Business and Wealth Show. Thank you for tuning in. I'm with Keith Blackborg here, and we're talking all things work optional, financial freedom, wealth, tax. So make sure if you're enjoying this, make sure you make some notes here, make some comments rather. And also we know the algorithms loves engagement. So give us a thumbs up, give us an emoji, give us something so that we can bring you more awesome guests, just like Keith here. And also share this with your friends, your associates, your partners. Share this with them so they can open up their mind around the other possibilities about wealth accumulation as well. So Keith, over to you. Any last things you want to say, things I should have asked you or shouldn't have asked you?
So the main point I want to make, if you really want to move the needle in this, it's going to require a little time. So number one, get educated. Learn from somebody like Mac, somebody who knows your kind of wealth and is going to help you with that. Secondly, get some strategic planning, whether it's from a professional that knows your business, something that you're trying to do, who can help you with your wealth strategy, tax strategy, whatever it is. Lastly, and the number one driver of my success has been masterminds. So get with other people of a similar mindset who are going the same direction. And by you guys meeting regularly and comparing notes on how to do things, they're peers that aren't trying to sell you anything. You guys are trying to just be each other's success. You're trying to help each other. That's probably going to be the biggest difference of anything that's going to make the biggest result for you guys. So those three together, education, professional strategic help, and the masterminds, you'll be set for whatever you want to accomplish.
Fantastic. I love that. Listen, how can people reach you or connect with you, Pete?
Sure. You can connect with me on my website, financialjourney.life. You can get on our free value-added newsletter, and I put out some of the best timely wealth tax strategies, some investment opportunities that I just think I don't get paid for, but I really think are a good opportunity. And I would love to connect with anybody who's interested.
Superb. Fantastic. Thank you so much, Keith. I really want to say, thank you for jumping on and really giving your knowledge and your experience and what you've been through, because there's nothing better than real life experience. So Keith, thank you. I want to say, everyone, thank you for listening in to this particular show, and remember to share and like as well. Until we speak again, thank you for being here. Appreciate